What's up, guys? It's Brandon from Amphibian Trading. Please remember to hit that like and subscribe button, and then we will get right into the action. So the markets had a short trading week with the half session on Monday and then the 4th of July holiday on Tuesday, but there's still plenty to talk about. We'll go over the indexes, talk about sentiment, and then lastly, we're going to talk about a stock's price in relation to the 10-week moving average. So let's start with the indexes, and here I have the NASDAQ composite pulled up. Last week, I had mentioned how we had this gap in price on the NASDAQ and that it was likely to fill this week due to the holiday shortened week, the lack of trading volume, just a lot of factors that meant this week probably was going to be pretty uneventful, which it is so far. If you look at the NASDAQ on the weekly change, we've changed less than 0.1% overall. So going back to that daily chart, Thursday, we had this gap down. It filled the gap here, and it resulted in a distribution day. However, if you look at the daily closing range, it was in the 91st percentile, which is very strong. This showed a lot of supportive action, actually. So this was about as healthy of a distribution day as you could have asked for. Now, overall, we have our distribution day count at 5 now, which is getting elevated, which isn't ideal. That brought the exposure count down to a 6 as of yesterday. However, here we are on Friday and we're getting another buy signal on the Market Navigator. So you can see we have this +1 showing that we're bringing our exposure count back to a 7. So the maximum recommended exposure levels are still at 100%. We are still in this power trend shaded with this green background, you can see, and we're trending above all of our key moving averages. So overall, the action here remains healthy, and it's exactly what you want to see on the NASDAQ. If we go over to the S&P, it is a pretty similar story. We have our power trend with the shaded green background. We're above our moving averages. We filled the gap from last week on Thursday. Again, we had the gap down. It was a distribution day. This one had a closing range of 71%, so still pretty healthy there, being in that upper half. And then today we're picking up another buy signal with that low above the 21-day moving average for a 5th consecutive day where we close positive. Now, I am recording this during market hours, so if the price were to reverse and go negative, this buy signal would be canceled. But as of now, we're getting that additional signal printing, bringing us back to an exposure count of 6 on the S&P. So let's go ahead now and talk about sentiment. So it's important to be aware that sentiment is starting to get stretched to the bullish side. It's important to remember that this is a secondary indicator, though, and price and volume is ultimately what you need to pay attention to. But if we bring up the AAII survey from this week, the bullish sentiment is at a 1-year high with 46.4% of the participants being bullish. Not only is that a new 1-year high, but it's also well above the historical average of 37.5%, while the bearish sentiment is also well below its historical average. So definitely something to watch there. Another quick sentiment gauge that we can look at is the Fear Greed Index, which is now sitting at extreme greed. However, you can see it's been sitting at the extreme greed for the past month, so these things can stay frothy for some time, and again, they're just secondary indicators. And it doesn't mean that we're going to have this big crash because everyone's bullish, but oftentimes when you see everybody starting to lean towards one side, there can be a quick shakeout to the other direction to bring sentiment back to neutral, or sometimes we can correct sentiment through time just by wearing everybody out. If everyone's bullish and the market goes nowhere, eventually people are going to get sick of being bullish. Now, if we go back to the NASDAQ, you can see we've essentially gone nowhere for these last 3 weeks. Price has just stayed inside this box. So now the question is, do we need to have a shakeout and then resume higher? Or is this digestion period going to be enough to wear some people out and gather some momentum for us to make another leg higher? So with the market in this digestion phase after its initial push higher, one thing I like to watch is how a stock acts in relation to its 10-week moving average. We want to see if a stock is drifting sideways, allowing the 10-week moving average to catch up, Or is price selling down to that 10-week? So I quickly just put together a list of some stocks we can look at as examples. So starting with Celsius, you can see this stock pushed higher. We've gone sideways, moved higher again, and now we're getting 3 tight weekly closes signified with this blue dot. And during that time, the 10-week moving average is just steadily rising, catching up to price. If we look at Dynatrace, we see the same thing. The stock moved higher and then it's just gone sideways, actually forming a flat base now. But all that time, the 10-week moving average just slowly catches up to price. HubSpot is another example of that. It broke out, moved higher. You can see it gets a little stretch from the 10-week moving average here. And instead of selling down to that average, it goes sideways, allowing the 10-week moving average to catch up. One more example of some positive action is Uber, pushes higher. It moves sideways. Now we have these tight weekly closes, again, just allowing this 10-week moving average to catch up. Now, if we look at something like Asana, you can see this on the other hand, it pushed up and then it sold back down to the moving average. This came down about 21% to have price meet the average rather than the average coming to meet price. Same thing if we look at a Duolingo from the high here. This one actually broke through the average but came down about 18%. And then lastly, DigitalOcean. This one actually rebounding this week nicely on volume. So there may have been some news. I'll have to look more into that. But if you look here, same thing. We pushed up higher and then price sold down about 21% to come back to that moving average, which is still within this basing structure. So those last 3 are acting much differently than, say, a Celsius, where again, you push higher and you just move sideways and you let the moving average catch up to price rather than having price come down through the moving average. So again, this is something I like to watch closely, as the best stocks typically show that tight controlled sideways action that allows that moving average to catch up versus the price coming down. So thank you for watching, and if you enjoyed this video or found any of the information useful, please go ahead and hit that like and subscribe button so you don't miss any future updates.